Hi everyone, we hope you're staying healthy in this pandemic and trying to make lemonade out of lemons. We wanted to share a video which is 1 week to go until the election and address questions regarding the markets and the election and how we and our clients should prepare for it. I've compiled a lot of information from a lot of different resources and try to organize it in a way that I hope will bring some new insight for you. I'll actually start with insight from Commonwealth Chief Investment Officer Brad McMillan, who's a friend of mine. He's always in the financial news if you've seen him before. I'll then share information from some of the largest institutional money managers in the world with their key takeaways and recommendations. Finally, I'll close with some personal perspective. It is a video with a lot of information, so I'm going to be going over it quickly. But luckily, you can always rewind if I go too fast. And since we aren't ready to host in-person gatherings yet, we would appreciate any feedback on our videos. Do you want to see more videos like this? What works, what doesn't work for you? This is probably a little bit longer video since it's replacing a lunch and learn. And as clients, you're the only reason we exist, and so we appreciate all your feedback. It is the stuff that we need to make ourselves better. So with that said, let me get started on this uplifting and easy political environment we're in today. We've reached the point in the election cycle where everyone is at wit's end. And guess what? We still don't know where we'll be in a week. We've had lots of questions from both sides about the effect of the upcoming election on the markets. Surely, the question goes, and note that it's not really a question at all, if candidate X wins, the market will tank for the following reasons. There were similar questions during the last election cycle. You probably remember the predictions of doom if Trump were to win. You probably also remember the election before that with the predictions of doom if Obama, the supposed socialist, were to win. Yet in both cases, the markets did quite well. Despite the real fears that are out there, the market has managed to move upward with both of these presidents. So what's the power of politics? Well, politics actually has less of an effect on the economy, and therefore the markets, than investors typically think. Since 1900, according to bespoke research, the average gain for the Dow Jones has been just under 5% per year, reflecting the economy as a whole. Decade after decade, the markets have moved ahead as the economy grew, regardless of whichever party was in power. And so when we do see this political influence, it's not what might have been expected. The average Republican administration over that time period saw gains of 3.5%, while the Democrats saw gains almost twice as much, of 6.7% per year. Again, this is all the way back to 1900. Recent decades have seen similar patterns, with annual gains under Clinton and Obama actually exceeding those of both Bushes and Trump so far. To put that in context, fears about the election look to be overstated. Trump is a known quantity, so if he's reelected, the effect should be actually relatively minor on the markets. If a Biden is elected, history shows that there's a good chance over time the markets will do well, and at least as well as they would under Trump. And of course, the big question, could it be different this time? It might. Biden plans to raise taxes significantly if elected, which would have an impact on corporate profit margins. If margins decline, so do earnings, and so does the stock market. The higher the taxes on the rich would also presumably hit their spending, which would be a drag on consumer growth. And these are real concerns. They are not, however, any different from the concerns that normally accompany a Democratic administration. And as noted, the Democrats have historically generated higher market returns. So why? Well, higher taxes are accompanied by higher spending, which also acts to stimulate the economy and the market. So we've seen the same effect in recent months when increased spending by the Trump administration has kept the economy afloat. And Biden administration would likely expand on that support, and we do expect to see some kind of stimulus from either candidate when they win. So is this normal? Actually, this is a normal political cycle. Republicans take office and cut taxes and spending, and then it swings and the Democrats take office and they do the reverse. We've seen this pattern many times before, most recently when we transitioned from Obama to Trump. It's also normal, however, for both sides to make the change look as apocalyptic as possible in hopes of motivating their donors and voters, and that is exactly what we are seeing at this moment. The headlines that point out these likely changes are designed to get really the maximum attention by maximizing the potential consequences. Hence, the questions and concerns we've gotten from you, our clients. So the reality, however, is likely to be much less scary. The next president will likely have to deal with a divided government, limiting the administration's ability to pass any landmark legislation. Even if the Democrats were to take the Senate, a Biden administration would not have a filibuster-proof majority and likely could not rely on all the Democrats to vote for anything radical. The American political system is designed to be hard to change. Nothing in this election will change that, no matter who wins. So where does that leave us? As investors trying to analyze the election, we should take note that there are certainly risks, but also opportunities. No matter who wins, there will be policy changes, but almost certainly nothing too radical. The real risk will come from reactions to the headlines, rather than to the underlying data. In other words, we should treat this like any other event and act on what actually happens, rather than on whatever disaster the headlines are peddling to us today. So, in Brad's words, keep calm and carry on. And so let's take a look here. I've got some slides from BlackRock. And the first one here says, stocks have continued higher regardless of presidential party. And I think it's important to note this Student of the Market election special that they put out last month is a really good visual here. And it shows that we tend to get concerned about which party might be better for the market, but historically the markets continue to rise regardless of which party's in office. This particular slide shows $1,000 invested in the S&P 500 when it first came out in 1926. And it is now $8.9 million this past June. And that is with Democrats and Republicans both in office. So let's flip to the next slide. U.S. stocks across the election cycle. So here's another good slide. Stocks have historically performed above average in presidential election years. However, they also tend to post the strongest performance in years where there is no presidential or midterm election. So as you can see in the slide there, and that again from 26 to the end of last year. Next slide here, investors build up cash in election years, and in particular this year. It's traditional that there's usually greater inflows into money markets in the years when there's a presidential election. This election year has seen historically large flows due to the combined effects of the election and the coronavirus pandemic. So, you sort of think about that and say, well, what's going to happen when we have that non-presidential years? We feel more confident because we know who's going to be in power. And so this is pretty typical that you would expect. And of course, this year it's even greater with coronavirus. So that bodes well because that cash will get put to work at some point. The next one here, divided governments in the U.S. stock market. So stock markets tend to post stronger performance when the White House and Congress are controlled by the same party on average. We have seen this happen roughly half of all presidential terms throughout history. And you can see on the left here, the same party 47 years and divided government 47 years. And of course the returns are there beside it. The next 1 and 3 years following the election, and you can see divided government and the same party. And so it's pretty interesting. It's very interesting from a 1 year and 3 year perspective, but again, you see it's all great returns when you look at long term. The next here is stocks across a presidential term, so you think about the 4 years. The third year in a 4 year cycle is often the highest performing year for the market. If a president is lucky enough to be elected to a second term, the stock market returns tend to reflect those of the first term, which is actually roughly around 12% on average for each term. So again, if the incumbent wins, they have similar results from the previous 4 years. Another slide here, new versus incumbent presidents. On average, stocks have historically performed better in election years where the incumbent president wins re-election. And you can see it's 13.4% there on the right, versus when a new president is elected, which is on the left at 9.3%. And of course, you see stocks and bonds, and you see kind of the inverse relationship between the two. Next slide here, number 7, asset class performance in presidential years. Now this is busy, you probably can't see it all that well, but what I would point out is that this year we're seeing asset class differentials, and the performance that they're seeing is much different than their historical average. And of course the reason is coronavirus this time. And so Different sectors tend to do better under a Republican or Democrat, as you can see in the chart, but this year is certainly an exception across the board for all sectors. And then another slide here I like to talk about is the market seasonality in election years. And so we joke about this mommies to mummies, so that's Mother's Day to Halloween. And then you see the turkey to tax, which is basically November to the end of April. And traditionally, the mommies to mummies period, May to October, have underperformed the turkey to tax. In election years, however, mommies to mummies tend to perform better than turkey to tax. So as you can see there, the election years, there's really the time frames are pretty equal. And so that's a little bit from BlackRock. There's some warm up on some statistics there. So let's look at some insight from Capital Group, which is most of you will know as American Funds. John Emerson, who's the vice chair of their firm and a former U.S. ambassador to Germany, actually, recently was quoted as saying, "I've been involved in presidential politics going back to the 80s, and I have to say this is the most unusual election of my lifetime, and probably anyone's lifetime who is alive today. We have a pandemic, an economic crisis, civil unrest, and in the midst of it all, a Supreme Court appointment suddenly enters the mix." And of course, he actually made these right before the president got COVID. So quite a different year that we're facing. And you can see the uncertainty index in this chart is very high this year compared to going back for the last 20. So again, political uncertainty is what we're looking at in this chart. The next chart that we have here is something you've probably heard about quite often in the news. The mail-in ballots may trigger election day turmoil. Largely due to the COVID outbreak, a record 80 million Americans are expected to vote by mail this election cycle rather than visiting the polls. And that means election officials will be processing more than twice as many postal ballots as they did during the last presidential campaign in 2016. Unless it's a clear landslide for Trump or for Biden, the outcome of the presidential election probably won't be known for days or even weeks. Particularly as states deal with the unprecedented volume of these postal ballots. High levels of market volatility would likely accompany this period of uncertainty. Moreover, Democrats are requesting mail-in ballots in much higher numbers than Republicans. So this could set up a scenario where election day results appear to favor Republicans, and then mail-in ballots, which take longer to count, shift the outcome towards Democrats. Either way, I would expect court challenges are going to be a predictable outcome in this one. And so what does that leave us? Well, that means that the counting will continue well past election day, as you see in this slide. And so some states don't start counting mail-in ballots until election day. A few of them are key swing states where the presidential election could be decided. These include Michigan, Pennsylvania, and Wisconsin. By contrast, other swing states such as Arizona and Florida start tallying mail-in ballots 2 weeks, sometimes 3 weeks ahead of time, respectively, as the ballots are received. In recent months, the subject of mail-in ballots has become highly politicized as well. So putting those partisan arguments aside, the simple fact remains that many states have never before handled such a high volume of these postal ballots. Under the best circumstances, it will be a challenge to count these votes in a timely manner. And as Capital Group mentions here, we have to be patient. Just because it takes longer to count the votes doesn't mean there's fraud involved. We have to wait a while to ensure we get an accurate count so the American people can trust the validity of the results. So we'll see this chart. Will the U.S. Supreme Court step in again? And you read the quote there. At the end of the day, I think it's important to keep in mind we will have a result. We will have a president, and I believe we will have a peaceful transition of power. So the disputed 2000 election was ultimately decided 36 days later when the Supreme Court, in a 5-4 vote, effectively ended recounting efforts in Florida. A key element of the decision involved a strict deadline. Under federal law, each state must determine its electors 6 days before the Electoral College meets. The deadline was December 12, 2000, an impossible task to meet if recounts were permitted to continue in Florida. The court handed down its decision the same day, and former Vice President Al Gore conceded the next day. In the closest election in U.S. history, President George W. Bush won with 271 electoral votes. one more than he needed. Could the Supreme Court be called upon again? And will that deadline, which this year it's December 8th, play a similar role? Well, only time will tell on that one. And here's the conclusion from Capital Group. And you can see by the slide there, very close to the slide I showed earlier, unified government and split Congress are actually very similar. Unified Congress with a president in the other party, however, is actually a little lower performance. And so it's important to remember that the political power structure in Washington, D.C. hasn't had much of a discernible impact on the markets. From 1933 to the end of last year, under unified and split governments, you can see the results that I'm showing you here. So it's roughly 7 to 10%. So a split Congress, as we have today, appears to be the market's favorite choice, but again, just incrementally better than a unified government. So what are the investment implications on this? Well, as American Funds points out, investors should prepare for rising market volatility as election day approaches, which we're already seeing, not to mention we're in an earnings season. Patience is key, as the outcome of the U.S. presidential race may not be known for days, likely weeks. The sheer volume of all the mail-in ballots means delayed results are probably inevitable, and so prepare for that. And despite the uncertainty, investors should remember that the markets have eventually moved higher, even in turbulent times. So that's American Fund's message. So let's turn over to MFS. And it says, as you can see the new slide here, the U.S. presidential election, let the games begin. In the coming months, many investment professionals, investors will attempt to predict future market moves based on the election outcomes. Markets can react to those outcomes in surprising ways, as they did in 2016, when markets climbed following the election of President Donald Trump, belying predictions of the market declines in the event of a Trump victory. And so, again, everyone thought that Trump was going to have a bad result for the economy and the markets, and it actually turned out the other way around. So the 2020 presidential race is gaining this momentum. We're right on the line here, and folks are trying to get familiar with policies and positions of the candidates. The stakes seem particularly high this election year. It's important to remember that every president must contend with the major domestic and international issues. The U.S. has withstood catastrophic wars, economic collapse, and yes, we've even had prior pandemics. But the economy is resilient, and the country is forged ahead. It's sometimes tempting to get caught up in the political narratives, but we think it's wise to stay focused on your goals and objectives, and don't worry too much about the bigger things that you can't control. When you look at a review of the country's history, it does reveal that there's much more complex and nuanced connection between which party wins the presidency and the economy or the market outcomes. The three-branch system of the U.S. government assures a balance of power among the executive, legislative, and judicial branches, but the contours of the political parties controlling each of those institutions are critical. When it comes to policy making and spending, the two chambers of the legislative branch, the House of Reps and the Senate, can act either as a counterbalance to the executive branch or as a political accelerant. So again, I think it's important to sort of understand whoever controls can have an influence. And I always say the government is either a risk or an opportunity, and we just need to make sure we're paying attention to which one it is. Here's another great slide here. It says Exhibit 1, the impact of recessions on presidential elections. Again, a lot of working parts leading into this election, but none might be as important as the historical context that I'm showing you here. Since the turn of the 20th century, incumbents have always been successful when the economy has not been in a recession in the 2 years leading up to the election. The inverse is also largely true, with the exception of Calvin Coolidge in 1924. Presidents running for re-election have been unable to overcome the corrosive impact of a recession if it's happened in the last 2 years to win another term. And to note, Coolidge was vice president under Warren Harding and then became president in 1923 when Harding died. So it's a little bit of a different situation. So summary here that no president besides Coolidge has been able to win a second term if there was a recession. Next slide, the economy and markets matter. And again, here's the fair or unfair, which which actually usually unfair. Voters' views of any president are often shaded by the state of the economy and the equity markets. We say that they're not as related, but for some reason we all, unfortunately, give them a lot more credit than they probably should have. Since 1924, when there has been no recession in those 2 years prior to the election, the incumbent has been reelected 100% of the time. On the 4 occasions when there has been a recession in the 2 years prior, the incumbent was voted out 3 times, as I mentioned in the last slide. Entering 2020, the U.S. appears to be on the path to continued economic expansion, but it was thrown into recession when states got locked down with the coronavirus. So while the recession was deep and abrupt, given its cause and global nature, it's kind of unclear if voters will hold President Trump accountable the way that they've done that in the past. And again, this GDP sort of shows it, and you can see 2020, this sharp drop off from the second quarter there. Next slide, the economy and markets matter. Again, looking at this is the S&P 500 performance 3 months prior to the election. And it's a similar dynamic when you look at these returns. When the U.S. stock market has been in positive territory 3 months prior to the election, the incumbent president has often been reelected. After a steep decline during the first quarter of 2020, the U.S. equity markets have been on a steady climb, reaching new all-time highs in early September before experiencing this increased volatility. So again, from the last couple slides, economy matters, and in this slide, the stock market matters. So there is some correlation between win or losses, whether or not that actually needs to be the case or not. Let's look at the next one. And slide title, it's about more than the presidency. And so again, I've shown you this a couple of times before. Little different time frame on this one, and this is the S&P versus the Dow. When it comes to policy making and financial matters, the president requires the cooperation of Congress to move his or her agenda forward. We all know this. Congress holds the power of the purse, so to speak, with the House of Representatives holding the exclusive power to originate bills for raising revenue, and the approval of the Senate and President required for bills to become law. But a historical analysis of equity market performance reveals that it's not affected much by who controls Congress, actually. Even when one party controls the House and the other Senate, Congress has shown it can act quickly and efficiently when needed, as it did at the onset of this pandemic. Republican-controlled Senate, the Democrat-controlled House, and the Republican president acted swiftly and collaboratively to pass the massive stimulus package that we got in March, and that was needed to provide economic support both to individuals and companies. It's really not clear if that cooperation will continue when Congress addresses future stimulus packages. Right now, it doesn't seem likely that's going to get done before the election. But I would sort of tell you that after the election, I would expect some kind of additional stimulus. There's just millions of people unemployed, and there's still a lot of struggling businesses out there. This shows, again, divergent policy paths, and these are 3 major areas. The platforms, they differ significantly. There are a lot of similarities, but Democrats and Republicans have moved farther apart on these key issues. Critical policy areas that we're seeing now are tax, international trade, and of course healthcare. Those are all going to be center stage, and so we need to watch those areas closely. But it ain't over till it's over. And so a potential source of greater than normal uncertainty surrounding the 2020 presidential vote is the increasing likelihood that the winner and perhaps the power in Congress might not be known on election night. So again, we talked about it, but the last time this occurred was 2000, when it took more than 5 weeks for George W. Bush to be certified as the winner. In the nearly 20 years since then, the U.S. electorate has become dramatically more polarized. So as you can see in the thing that I'm showing here called Exhibit 4, it illustrates this point. In the election since 2000, on average, the unfavorability ratings of the 2 major party candidates have been trending higher. Across the board, everybody's unfavorable about either candidate. Against this backdrop of a global pandemic, civil discord that's going on, and continued income inequality in our country, it's certainly an uncertain presidential election outcome could fray already pretty raw nerves, leading to an increase in market volatility. So we don't we don't want to tell you that there's not going to be volatility. But for historical context, during this bitterly contested 2000 election, the index fell about 10% between the close of business on election day and the lowest point, which was November 30th. On December 12th, the day that the U.S. Supreme Court decided Bush versus Gore, halting a selective manual recount in Florida, which then gave Bush that one vote majority, the index stood about 5% below its election day close. So deeper partisan divides in 2020 suggest that another contested election could have profound implications, some of which could spill over into the markets. But again, that was about a 10% top to bottom, 5% within the 5 weeks it took. And 5% over 5 weeks is not as dramatic as a move as what we saw earlier this year. So what does MFS say to us? Well, surprising. Stay the course. Election outcomes can have deep political, economic, and social implications. Unfortunately, the balance of power does not lie in the hands of a single person or a single party, but rather in the system of this distributed power. It's designed to keep politicians in check. Democratic process and the constant push and pull of political process has provided the framework for both the U.S. economy and the stock market to become the largest in the world. In election years and other times of change, it's important just to not let the news headlines knock you off your course. Maintaining your disciplined investment approach, your long-term time horizon, and sensible rebalancing and things that we do for you is a sound approach in this year, of course, and in other years. And you can see that the contrast between the candidates is widening, which might also influence other highly contested races that could tip the balance of power in the Senate. Due to the variability of these outcomes, you can see there we're wary of developments in numerous sectors. So we're paying particular attention to which sectors might benefit, which ones might be at risk. So that's why we stay diversified. We don't know who's going to win, so you don't want to put all your eggs in one basket. And again, spreading your holdings out not only amongst the different sectors and industries and companies, but also even geographies and investment styles can help increase your diversification and sort of mitigate some of this volatility. Here's a quick slide I wanted to add in from Franklin Templeton, and it's just a couple bullet points. It was overall a very strong economy until the pandemic began. So COVID-19's effects and its rates of infection, disease, and mortality have created all this uncertainty, not only in our markets, but also globally. Franklin Templeton believes a split Democrat and Republican-led government would actually be quite good for the markets. And again, the prospects of a blue wave sweep, we believe for investors would be concerning, as we'd see a dramatic shift in government posture. And so, the markets and businesses are a little bit concerned about that, but again, in the long run, it probably won't matter. Both Democrats and Republicans actually agree on a few things: infrastructure spending, China trade and intellectual property issues in particular, and bringing our supply chains back to domestic production. There are some differences even within those, though. So, what defines infrastructure, how technology would be employed, all of these kind of considerations as well too. And then finally, from Franklin Templeton here, technology has become a fundamental part of infrastructure and how the United States and other countries project power, we believe, and the technology companies are a big part of that global power structure. So, again, we need to pay particular attention to those. The EU, for example, recently said they were focusing on the top 15 largest U.S. companies for privacy issues. So, again, things to watch. This is a great little group of slides that I've put together here from Invesco. So wanted to kind of go through these. Talks about our 10 truths no matter who wins. And I'm going to go through those, so I'm not going to read them here. But I would show you that quote. Be sure you put your feet in the right place, then stand firm. So let's look at this first one. Markets have performed well under both parties. And you can see this. They're similar to previous ones I've shown you, but presented a little differently in a little different time frame. This shows the S&P has delivered approximately 11% over the past 75 years through both Democrat and Republican administrations. It's expanded about 3% economically during that period of time, with again 11% market returns, a little over 3% growth in the economy. The stock market's returns were negative for presidential administration only when the country was in the 2008 financial crisis and when we were experiencing stagflation in 73, as you can see there under George W. Bush and Nixon. So neither party can lay claim to superior economic or actually financial market performance. Next one here, investors are better off staying fully invested. And you can see, it's kind of hard probably to see on this, but this is $10,000. And it says the best performing portfolio, or shows the best performing portfolio over the past 120 years was the one that stayed fully invested through both Democratic and Republican administrations. So 10,000 grew to 7 million if you just stayed invested. Partisan portfolios, which only invest when their party was the president, underperform absolutely drastically. I mean, there's not even a comparison. Neither one got to $1 million. And so it's in part the fact that the U.S. stock market has rose consistently over this time frame, even while enduring 2 world wars, 2 major world financial crises, the Great Depression, the Great Recession. And so, the rule here, or the recommendation here, or the fact here is that the more time investors spend as investors, the better they do financially. Next slide. We don't radically re-engineer the U.S. economy. And so among the biggest fears that people have is that some progressive candidate's going to come in and radically re-engineer our economy. Remember, though, that all presidents need control of Congress, and our system of checks and balances resulted in the last 2 presidents getting 1 signature achievement done before they lost the House. Despite concerns about major government policy changes, business investment and government spending have been remarkably consistent as a percentage of GDP, as it shows in this one. So again, 1965, the Great Society, Medicare and Medicaid passed, 81, the Economic Recovery Tax Act, 96, Personal Responsibility and Work Opportunity Act, and 2010, the Affordable Care Act. So again, things that people may feel that are going to radically re-engineer the economy, but they really haven't. Another view of this is to show the Dow Jones during that time frame. Even through this enactment of all these major government spending programs, the Dow Jones has still achieved approximately 10%, which is, again, explaining that we don't radically change our economy with one cycle. I like these next 2 slides. The historical narrative is not as you remember it. So when we think about different time frames, so we try to think about the past and how it will inform us for our future. But did we even get history right? And so, I kind of challenge you, who of you or who of us really remembers that Jimmy Carter presided over significant job growth? Or that under Reagan, income for those in the 50th percentile of the population, and again, that's ranked by income, grew by almost 20%. So these charts show a metric for each president in dark blue compared to the long-term average of that same metric, and these are since World War II. The next here, the historical narrative is not as you remember it, slide 2. And we'll come back a little closer to today. You look at President Obama's term. Despite concerns that his policies would be massively inflationary, the U.S. had one of the longest disinflationary environments on record. And I remember in 2008, all this government debt was going to cause massive inflation. Well, we just haven't seen it, and we still haven't seen it. Of course, and under President Trump, capital expenditures have been below their historical growth rate. So, we hear about the large corporate tax cut, and what that's supposed to be is, spark capital expenditures. So, you think about it, and clearly history is often remembered differently than actually what the data is truly showing us. And then, I think this is also very important. I mentioned it earlier, but major legislation is infrequent, and its impact is often unexpected. So when you think about these predictions and assessments, they're just far removed from actual results. So the ACA, Affordable Care Act, was predicted it was destroy small business hiring. But since 2010, 8.6 million jobs have been added, just in this sector. So I think it's important to note. Again, maybe it's not directly tied to ACA, but I think it's more important to say that ACA did not hinder that growth from happening as well too, because the data's here. Another example, the Tax Cut and Jobs Act was intended to unlock the capital expenditures, as I mentioned a couple slides ago. But so far, it's failed to bring this acceleration of business investment. Explanation may be that business confidence in 2019 was weak amid the uncertainty over trade, particularly with China. And so that's one of the things I mentioned last year. We really need to get some resolution out of this so businesses feel confident again. But in both of these cases, the president's lost single-party rule as the House of Representatives flipped after their signature accomplishment was enacted. So again, under Obama or Trump, they got one thing done, and then the House flipped. And then, just mention this one, just flat out, predictions tend to be wrong. We've always resisted making market calls based on presidential elections. And why is that? Well, because such calls rarely get it right. The past 10 years provide a case study. Two very different presidents have had similar market performance. Take a look at the next one. Growth stocks have continued their spectacular run against value stocks as companies find ways to grow revenues faster than the headline rate of economic growth, and those are rewarded. It's a far cry from what President Trump's policies were expected to do. They were actually expected to accelerate growth, thereby raising real yields or interest rates, steepening the yield curve, and unlocking value. If you've been paying attention, value stocks have actually haven't received this catalyst, and so they've actually underperformed growth stocks pretty dramatically. So these conventional narratives are often wrong when it comes to what the candidate's stated policy is and what that policy is going to do. So the end of the healthcare stocks in 2008 was one I always highlight. Since then, that sector has returned 15.3% annualized. So the S&Ps have been almost 16% since 08. Again, the bottom of the market, but healthcare is right up there with the overall S&P 500, and so it just didn't happen. And of course, contrary to all prognostications that are out there, the U.S. 10-year yield has been lower during President Trump's term than it was under Obama. Again, we're supposed to get growth, interest rates are supposed to go up, but it actually has trended back down. And so what's that mean? So, that some of these things don't matter, but what does? Actually, monetary policy matters more. And so for all of this focus that we put on the president and the executive branch, we would actually argue that monetary policy matters more. The old adage holds true that you should not fight the Fed. And right now, currently, the Fed is providing policy support, but doesn't intend to cut rates meaningfully anymore because it's basically cut them. As a result, we would expect the current environment to remain relatively benign for stocks and the yield curve to keep steepening modestly. So again, slow growth from here with interest rates not moving. Historically, presidents have been hurt or helped by monetary policy conditions though. So if you think about Reagan and Clinton, they benefited from consistently falling interest rates though, both of their two terms. Which is referred to as the Great Moderation, if you know that. During President George H.W. Bush and George W. Bush, Fed was tightening. So we had an inverted yield curve, and we actually had recession. So those actually hurt, as you can see in the chart there. And then President Obama benefited from a benign rate environment during his term. So there was a little bit of time in 15 and 16 when the interest rates started trending back up, and actually the markets didn't do well. And President Trump was the unfortunate recipient of tighter policy during his first 2 years. So if you kind of remember a couple years ago, interest rates were actually moving back up, and we were getting paid to have some cash on hand. But that has since been cut to zero. So again, markets have done well during these periods of easing financial conditions, and right now we are in one of those moments, and at best case scenario, it'll be benign. I don't know that they can cut rates any further, and it doesn't sound like they would ever go to negative. And I love this one. Markets don't care if you don't like who's president. Investors don't have to love what's going on in D.C. to prosper. Some of the best returns in the market came with presidential approval ratings in the low range, which is between 36 and 50%. And it's highlighted there in red. Some of the market that delivered its best returns during these periods, and half or more of the country did not approve of the current administration's job. So let me say that again. More than 50% of people disapproved of the presidential job and how they were handling that. But we had the best results in the market. So it's kind of hard to discern if there's a direct relationship between popularity in the health of the U.S. economy and the performance of the financial markets, but it is something to note that approval ratings don't give us a clear indication. And this next slide, this is not the most vitriolic election that we've ever had. It might feel like it, particularly if you watch the debates. But this cruel and bitter criticism has always been a part of our political process. And I'll bring up this somewhat as a joke in this day and age, somewhat as maybe a sad fact. But the worst incidents of press-facilitated slander against national heroes like Thomas Jefferson and even George Washington himself induced presidents to be really frustrated with the press. And of course, one of the most infamous duels in our history was a result of these political disagreements. On the cliffs of Weehawken in 1804, Alexander Hamilton, the former U.S. Secretary, fought with Aaron Burr, the then sitting Vice President of the United States, which actually led to the death of Alexander Hamilton. As long as Vice President Pence isn't fighting any duels, we're actually maintaining a higher level of political discourse today than we can actually find in history. Although it might not feel it, and we might not remember that too fresh. And then this one, don't take punditry as objective market analysis. This fact, just don't do it. Looking at Invesco's slides here, well, what is their concluding prediction? Well, they decided to withhold. They don't predict, which most folks would not, because you shouldn't. But one thing they said to watch is this, which is the misery index. It's the combination of unemployment and inflation. As of now, the index suggests a path for re-election for Trump is going to be very challenging because anytime that misery index escalates, the incumbent lost. So regardless of who your favorite is, don't let your favorite election indicators or the ultimate result disrupt your financial plan. So consider the predictions of Mark Cuban, the entrepreneur, who thought the market would just tank if Donald Trump won. Or the economist Michael Baskin, who believed that President Obama's policies were going to kill the Dow Jones and all the stocks in it. These dire predictions have disappointed voters. They just don't come true. And so, again, don't get too caught up in who says what's going to happen out there. And following up on that, regardless of who your favorite is, again, don't let it disrupt your financial plan. Consider that these performance has been there regardless of whatever else is out there. So again, you can see it from the chart here, Dow Jones and the S&P 500. And there's the quotes from Baskin and Cuban. In the event Donald wins, I have no doubt in my mind the market tanks, said Mark Cuban. And of course, Obama's radicalism is killing the Dow. Our new president's policies are designed to radically re-engineer the market-based economy, from Baskin in 2009. Again, I already mentioned that that's not what we do. So I've got a few more slides here before I close. These are from one of the data companies that we actually utilize. And these are some that I haven't touched on yet as we sort of get here towards Election Day. And the question is, how differently do markets perform when a candidate is leading in the major polls? More than anything, the markets hate uncertainty. And so as you see this, when the candidates are tied, the S&P 500's daily and their cumulative returns are negative. On average, the market tends to favor a Republican candidate leading up to the election when the Republican candidate's leading in the major polls. But overall, it's better to have somebody leading than no one leading. So again, the uncertainty drives the market crazier than who's going to win. And how differently do markets perform when a candidate is leading in the major polls? Well, two strong examples of this are seen here. So there's the '88 election when President Bush defeated Michael Dukakis, and again in 2000 when his son George Bush defeated Al Gore. And you can see by the chart there, Republican leading into the polls. Democrat leading into the polls, and so again, you sort of see that in the chart as well too. What about when the major polls are wrong? So there's been 3 times since 1950 that this has happened. 1976 when Carter defeated Ford, 12 when Obama defeated Romney, and 16 when Trump defeated Clinton. The market initially moved lower following the Democrats' 2 surprise wins, but actually ended the year positive at 5.4 and 2.3% in 76 and 2012. In 2016, the lone Republican comeback win, the market responded immediately by moving higher and picked up 3.5% between Election Day and the end of the year. So again, you think about it, in the first one, Jimmy Carter beating Ford, the market ended the year at 5.4% positive, which is actually higher than when Trump beat Clinton. So the bottom line here is that if you made your major investment decisions based on the president's political party, you're probably hurting your portfolio. It's time in the markets, again, not timing the markets, that become the real source of returns for people over time. And so that's the slides. I got a couple other ones that I wanted to mention. Taxes are a big issue. I stated here, no need to speculate. This is an area that we are watching closely. Depending on the outcome, we would expect stimulus first from either party and then tax changes later if Biden were to win. Right now, I would tell you not to get too far ahead of the legislation. If change is coming, we will see it coming, and we will talk about it and position around it at that time. There is a big item that's there's a lot of discussion about, which is the corporate tax rate, which the Trump plan reduced. I would just mention Biden's current proposal has rates going up, but they are not proposing to go as high as they were under the Obama administration. So again, an increase from where we are, but not as high as where we were 4 years ago. So, again, the key indicator here is that worry is greater than the actual threat. But there are some areas you can see on the screen here that we're paying close attention to. And so I got 2 final slides in conclusion. So, and you can see it here. As an investor, the most important cycle to watch for is your own life and its cycles. And we believe in understanding your investment time frame and helping you continue to think long term. Elections and market cycles come and go. However, they may offer opportunities to purchase stock at discounted values if there's volatility. So when I think back about the 20 plus years that I've been in the investment industry so far, there's one factor that reigns above all others when it comes to these elections. That is, what happens during a presidential term is more likely to impact our economy and our markets than what a candidate sets out to accomplish. So think about this, we will remember presidents based on what they had to deal with during their term rather than what they said they were going to get accomplished. So in this next term, we sort of believe that coronavirus will continue to be the major factor affecting the economy and the markets, regardless of whoever wins. And so 2021 and even 2022 will be directly tied to the way the U.S. and the world handles this pandemic. The second major issue that we sort of see coming up is the trade negotiations with China. I kind of feel like some of that got stalled, that there was a lot of stuff going on, and then a coronavirus hit, and then it got nasty again. And so, but we do need to return to those discussions because they're not done. And so we need to see what happens, and the market is really interested in seeing how that progresses. And then third, domestically, of course, unemployment is going to be a big issue. So I would tell you, again, coronavirus, trade, unemployment. After that, then we can start looking at what type of legislative changes are going to be proposed and what kind of risk and opportunity that those provide for us. So, at Pathfinder, we're here to solely for one reason, which is to help guide our clients forward. We invest based on your personal outlook, your personal time horizon, and your financial situation. We don't do it on Wall Streets or Main Streets or Sesame Streets. And so, I just make sure that you understand that your time frame is much more important than, the next 4 years. So I got one last slide. And it's a sketch from Carl Richards. he was actually a certified financial planner, and he's now become a national speaker, and he's known as the sketch guy because he does these cool sketches. And so this is in his words. Just pause for a second and take a look at it. Take a second to think about it. This is one of his favorite sketches, and I think that's because it speaks not just to our financial lives, but to our complex, sticky, tricky, emotional lives as well. When we only have so much time, energy, and attention, only so much we can focus on, how do we decide where to place that focus? So when he's trying to answer this question, he thinks back to this sketch. He takes a step back and he asks himself two questions. Does it matter? Can I control it? Unless the answer is yes on both counts, you can basically stop thinking about it. He writes, for the list of things I can stop thinking about, it includes whether my children get into college or not, because I can't control that. Whether I could have saved $5 on groceries by going to a different store today, because that doesn't matter now. Whether the stock market is in flux right now, because I can't control the market. And that guy who just cut me off in traffic, because it doesn't matter anymore. As he drives home from work, not thinking about any of those things, he suddenly is freed up to think about the things he can control and that do matter to him. For example, how I treat my children regardless of whether college is a good fit for them or not. How he can get his shopping to align with his values. How he behaves when the stock market fluctuations happen. And learning to count to 10, taking a deep breath and letting go when other drivers act like jerks. So just imagine what might happen if we quit worrying about the things we have no control over and quit obsessing over things that don't matter. Where else might we be able to invest our extra time, energy, and attention? At Pathfinder, we invest our time, energy, and attention in what we can control for you, what matters for you and to you, and we hope you'll do the same for yourself. Thanks for watching. Please let us know if you have any questions, and please be safe. There's likely, after the election, sometime whenever that happens, we'll put out one talking about the risk and opportunities in a new term. And please, everyone, stay safe.